The 10R trade. To most traders, it represents the mythical unicorn, the elusive win that transforms a trading account, that validates months of disciplined execution, that stands as a monument to patience and strategic precision. But here's what separates the professional from the perpetual amateur. The elite trader doesn't stumble into a 10R winner through luck or hope. They engineer the conditions that make it possible, and more importantly, they possess the psychological architecture to allow it to fully materialize. This distinction, this subtle but profound difference in mental framework, is what we're going to dissect today, because understanding the psychology of maximizing wins isn't about greed or aggression. It's about confronting the deepest, most uncomfortable truths about how our minds sabotage our greatest opportunities. Let's begin with a fundamental observation that most traders never fully internalize. The mathematics of trading performance are brutally asymmetric. You can be right on direction 60% of the time, and still fail catastrophically if your winners are smaller than your losers. Conversely, you can be right only 40% of the time and build generational wealth if you allow your winners to run to their full potential. This isn't theory. This is the empirical reality that underpins every successful trading methodology ever documented. The psychological challenge, then, isn't primarily about finding winning trades. It's about having the mental fortitude to extract maximum value from them when they appear. And here's where human nature becomes the ultimate adversary. When you're sitting in a trade that's already returned 3 times your risk, something primal activates in your nervous system. That dopamine hit from unrealized profit creates a biological urgency to lock it in, to make it real, to transform the abstract into the concrete. Your amygdala, that ancient part of your brain responsible for threat detection, begins sending signals that sound remarkably like rational thought. This could reverse at any moment. 3R is excellent. Why risk giving it back? Take the money. And in that moment, what feels like prudent risk management is actually loss aversion masquerading as wisdom. Because loss aversion, that well-documented cognitive bias where humans feel the pain of loss approximately twice as intensely as the pleasure of equivalent gain, doesn't only apply to losing trades. It applies with devastating effect to the act of watching open profit potentially diminish. The fear of regret, of having had more and watching it evaporate, becomes psychologically indistinguishable from actual financial loss. This is the first psychological barrier to the 10R trade. The inability to separate unrealized profit from your sense of security. Elite traders have trained themselves, through painful repetition and conscious cognitive restructuring, to view unrealized profit not as money they possess, but as information about market behavior. When a trade moves strongly in their favor, they don't see their account balance increasing. They see the market validating their thesis with increasing conviction. They understand that strong directional movement, particularly when it breaks through significant technical levels or occurs on expanding volume, is the market's way of communicating that a larger structural shift is underway. The amateur sees profit. The professional sees probability shifting in real time. But even understanding this intellectually doesn't solve the problem, because knowledge and behavior are separated by a chasm that can only be bridged through emotional regulation and systematic preparation. Consider what happens physiologically when you're in a winning trade. Your heart rate elevates, your attention narrows, you begin checking the position more frequently, each refresh of your platform delivering a microdose of either anxiety or euphoria, depending on the momentary price movement. This heightened state of arousal is the enemy of strategic thinking. It collapses your time horizon. It makes you reactive rather than responsive. And most critically, it disconnects you from the pre-planned framework that you established when you were in a neutral, rational state of mind. This is why the psychology of the 10R trade actually begins before you ever enter the position. The elite trader has already done the most important psychological work during the planning phase. They've identified not just the entry and initial stop, but they've mapped the trade's logical price path based on market structure. They've identified the levels where partial profits might make sense, not based on arbitrary reward-to-risk ratios, but based on where the market's character is likely to shift. They visualized in advance what it will feel like to be up 5R, to watch it pull back to 3R, and to hold through that discomfort because the structural thesis remains intact. This pre-commitment, this mental rehearsal of the emotional journey, creates a psychological buffer against the in-the-moment pressure to exit prematurely. There's a concept from philosophy that applies here with remarkable precision. The distinction between first-order desires and second-order desires. A first-order desire is immediate and reactive. I want to close this trade right now and lock in the profit. A second-order desire is reflective and aligned with your larger identity. I want to be the kind of trader who executes their system with discipline and allows winners to reach their full potential. The trader who cannot access their second-order desires in moments of stress will forever be controlled by the immediate gratification impulse. They will forever cap their winners at the point where emotional discomfort peaks, which, ironically, is often the precise moment when the biggest portion of the move is just beginning. Let's talk about what actually happens in the market during a significant trending move, because understanding the mechanics helps anchor the psychology. Markets don't move in straight lines. Even the most powerful trends are characterized by what we might call the rhythm of accumulation and continuation. Price makes an initial impulse move, then consolidates as early profit takers exit and new participants evaluate the shift. This consolidation often retraces a portion of the initial move, perhaps 30 to 50%. And this is the moment that separates the trader who will capture 10R from the trader who will close at 3R. The amateur sees this retracement as threat. The professional sees it as the market-building energy for the next impulse. They understand that robust trends require these pauses to absorb supply or demand and to bring in the next wave of participants who missed the initial move. But holding through this consolidation requires something deeper than pattern recognition. It requires what we might call ego suspension. Your ego is deeply invested in being right immediately and continuously. It wants validation in every moment. When price retraces against your open profit, your ego interprets this as a threat to your identity as a competent trader. It whispers that you should have taken profit at the high, that you're being foolish, that you're about to transform a winner into a loser. This narrative is so compelling, so immediately emotionally resonant, that most traders capitulate to it without even recognizing it as a cognitive distortion. The elite trader has learned to observe these thoughts without being controlled by them. They've developed what psychologists call metacognitive awareness, the ability to watch their own thought process as a neutral observer and to recognize emotional reasoning when it appears. There's also the social dimension that rarely gets discussed. Trading is often a solitary activity, but we exist in social contexts that shape our perception of success and failure. When you tell someone you made 3R on a trade, you receive validation and admiration. When you tell someone you held a trade from 3R back down to break even while waiting for it to develop into 10R, you often receive judgment and incomprehension. The social reward structure is optimized for quick, certain gains, not for the patient extraction of asymmetric returns. This creates a subtle but persistent psychological pressure to optimize for storytelling rather than for outcomes. The elite trader has either insulated themselves from these social pressures or has deliberately cultivated a peer group that understands and values true edge, the ability to sit with discomfort in service of larger gains. Now let's address the most counterintuitive aspect of maximizing wins, the role of deliberate discomfort. Every trader has a comfort zone in terms of reward to risk. For many, it's around 2 to 3R. This is the level at which they feel they've had a good trade, where the gain feels meaningful but not greedy, where exiting feels justified. But here's the crucial insight. This comfort zone is arbitrary. It's not derived from market behavior or statistical analysis. It's derived from your nervous system's tolerance for uncertainty. And your nervous system's tolerance is trainable. The trader who has never held a trade beyond 5R will experience overwhelming anxiety at that level because they're operating outside their psychological homeostasis. But the trader who has systematically exposed themselves to holding winners longer has expanded their comfort zone. They've recalibrated what feels normal. This is why the path to 10R trades is, at its core, a path of graduated exposure to psychological discomfort. Consider what this means practically. It means you must deliberately practice holding winners past the point where you want to exit. It means you must experience the discomfort of watching profit diminish temporarily and not reacting. It means you must build a database of experiences where patience was rewarded, so that when your amygdala activates with its urgent warnings, you have empirical evidence to counterbalance the fear. This is not about being reckless or stubborn. It's about recognizing that your instinctive exit point is likely premature, programmed by evolutionary biology that optimized for immediate survival rather than for trading asymmetric markets. There's also the question of how you measure success. which fundamentally shapes your behavior. If you measure success by win rate or by the consistency of positive days, you will inevitably cap your winners because you'll prioritize certainty over magnitude. If you measure success by the overall distribution of your returns, by the right tail of your outcome curve, you'll make very different decisions. The elite trader has internalized that their performance is not defined by any single trade, but by the aggregate shape of their results over dozens or hundreds of trades. This statistical mindset creates psychological permission to let individual trades develop according to the market's time frame, rather than their emotional time frame. They understand that one 10R trade can mathematically offset 5 small losses, and that their job is not to be right constantly, but to be positioned correctly when the big moves occur. But perhaps the deepest psychological element is this: the willingness to be temporarily wrong in service of being ultimately right. When you hold a winner through a retracement, you are accepting a period where you could have had more. You're accepting that if you had exited at the local high and re-entered at the pullback, you would have more profit. This hypothetical alternative timeline is a form of psychological torment that only exists because you're aware of the path not taken. The amateur is destroyed by this comparison. The professional recognizes it as meaningless noise. They understand that trading is not about optimization at the individual trade level. It's about executing a process that produces optimal results at the portfolio level. This requires the humility to accept imperfection in execution and the wisdom to distinguish between a flawed process and the natural variance of probabilistic outcomes. The 10R trade is ultimately a referendum on your relationship with control. To achieve it, you must relinquish the illusion that you control market behavior. You must accept that your only control is over your response to market behavior. You must position yourself in alignment with potential large moves, manage your risk so that you can withstand the journey, and then surrender to the process. This surrender is not passive. It's the active choice to honor your systematic framework over your emotional impulses. It's the recognition that the market will deliver exceptional returns to those patient enough to receive them, but it will not do so on your preferred timeline or in your preferred manner. The trader who needs the market to validate them continuously will exit early. The trader who can tolerate ambiguity and temporary discomfort will be present when the exceptional returns materialize. So when we talk about the psychology of a 10R trade, we're really talking about identity. We're talking about who you become in the crucible of uncertainty. We're talking about whether you optimize for feeling good in the moment or for building wealth over time. We're talking about whether you can delay gratification, manage your nervous system, and execute a plan that your rational mind designed even when your emotional mind is screaming for relief. The 10R trade is not a market phenomenon. It's a psychological achievement. It's the external manifestation of internal mastery. And every trader has access to this achievement. Not through some secret strategy or indicator, but through the deliberate cultivation of the mental architecture that allows extraordinary outcomes to unfold. The question is not whether the market will provide these opportunities. It will. The question is whether you'll have built the psychological capacity to recognize them and the emotional fortitude to let them fully develop. That's the work. That's always been the work.